Hello traders, Gary Wagner here. It is currently about a quarter to 10 in Honolulu, quarter to 4 in New York City, the third day of April, one will remember, 2012, Tuesday. This is the daily report for the precious metals markets, gold and silver. We currently find ourselves under tremendous pressure as this morning minutes from the FOMC meeting from the 13th of last month were released, and apparently the belief or assumption that another round of quantitative easing was squashed, nipped in the bud, so to speak. The knee-jerk reaction that follows was strong, to say the least. We're currently trading off over $30 in gold, currently $16.44. Putting it down almost $33 on the day. In terms of percentages, almost 2%. 1.2% lower in silver, off 39 cents, 32.70. Platinum down 10, and palladium currently trading down 4. We have a lot to cover on today's show. We're going to try to make sense of this market folly that we're witnessing, but if you recall, I sent out an advanced release of my latest Kitco commentary, which went live this morning. And one of the topics that I talked about was that as pure as mathematics is and technical analysis, simply put, there's one large caveat. And that caveat is, realize, traders, that technical analysis simply distills information and distills market sentiment as global events are reacted to. So therefore, it will lag behind those global events. And as I put it in the article today, no one really knows when the bus driver decides to turn the wheel. Traders, you know, when the Fed speaks, the world listens. And the knee-jerk reaction that we witnessed today was part and parcel due to the fact that there is a true division currently among the presidents of the central banks within the United States. And on the question of QE2, this division has pushed traders into a quandary and into an area in which there now again is a lot of uncertainty. Let's take a look at the charts, and you can see that we're recuperating and we're trading well off of this morning's low. First chart we'll look at, of course, is going to be our Standard & Poor's. It's a 60-minute chart. It is in straight candlestick format. You can see the top. You can see the reaction that the release of the minutes had. 1405 in terms of the S&P 500. That was the low. And now we're forming a candlestick pattern I'm sure most traders will recognize. And that pattern, of course, is a three-river morning star. Again, as the market has been in a downtrend, it begins with this long red candle right in here, a star in the center, and this is a pure doji. If you look at that, the open and the close are identical, and that, of course, is followed by a green or up print candle. Now, realize this is, of course, a short-term chart, but the patterns are just as relevant and provide valuable information, whether it's short-term or long-term. When we take a look at the dollar index, and let me move that over for us traders, you can see that we have had a basic reversal, and a basic reversal from the downtrend that we have seen in the dollar. In other words, we look at this top up at around 81. This is back around the 13th of last month. Market comes basically down to form that bottom just below 79, and you can see how the Henkin Ashi candles themselves drastically change colors and direction upon release of the minutes from the FOMC. Now, traders, the first chart that I really want to look at in gold is going to be a very, very short-term chart. And the reason for showing you that is look at the chart damage that was inflicted in the gold market in a 1 hour period. Because at the beginning or top of the hour, market's trading at 1670, and within a very short period of time, 1 hour, it trades to this intraday low, $30 lower at 1640. And traders, you can absolutely see the difference. We've converted it into our Henkin Ashi chart, and you can see that it is still showing red, although it's showing an inside trading cycle. Traders, now I've converted that 60-minute into a very, very short-term chart. It's currently a 5-minute chart. And the reason for that is to show you that as this market came down, this is that bottom 1640 right in here. You notice we get a series of doji candles right in the center. Then we go green. In other words, whether it be short covering or a buy the dip mentality, traders did step into the market either to cover short positions or because they felt that the price was inexpensive or undervalued. But at this point, as you can see, we've got this doji and we are back to red. My sentiment is we absolutely need a couple of days to kind of let the dust settle. I absolutely believe that what we have seen today is a knee-jerk reaction to an assumption within the marketplace. And as we all know, those assumptions can change literally at any moment. Now, we're going to take a look at our 480-minute chart. And here is where we're in a quandary, because on our basic wave count itself, we have inflicted some true damage. So we're going to have to analyze this recent activity, because when we take a look at the recent price move, 1, 2, my belief was that we had gone into our impulse, which was 3, but this candle today certainly doesn't follow within suit in terms of that wave count. The other thing is that on a true Elliott wave count, wave 3 cannot go into the trading territory of the prior corrective wave. Well, it certainly has, as you see it move down. Now, on the positive side, looking at it from a bullish standpoint, what we are also witnessing here is, in essence, this double bottom. As you can see, I'm basically looking at where the low is from this recent low that we had and comparing it to our trading activity right now. And as you can see, although we have made a new low, this low on the market I believe was around 1638, and the prior low was 1642, it's still well above what I consider to be major support, which is still sitting anywhere between 1623 and 1628. So as I said, we're in on an average price at $16.50. It is roughly $4 to $5 against us. That's not too much damage. We really need to be rational at points like this, let the dust settle, and then make our observations and, of course, act accordingly. Silver, the same thing, although it hasn't inflicted nearly the same type of damage. But yesterday, we talked about the fact that I felt we might run into some real resistance, and I drew this particular line representing a resistance area. Of course, this resistance area is matching to these two prior tops, and lo and behold, this was a resistance level for at least the interim the silver market is unable to overcome. Now, average price in our silver position, $32.50, $32.40, current print, $32.54. So we're at a push on that particular trade. As I said in today's article, as pure as technical analysis is, and traders, those of you who have been with me for a while, a year or 2 years, you know how strongly I follow the tenets of technical analysis and combine that as a hybrid trader with fundamentals. But one must always realize that at the drop of a dime, at a moment's notice, every assumption that we are currently basing our trades upon can change, and we have to be able to act accordingly. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.